How central bank decisions shape your financial future. Welcome to today's video. Central banks are among the most powerful institutions in the global economy. Their decisions on interest rates and monetary policies have far-reaching consequences that affect not only governments and corporations, but also everyday people like you. From the loans you take to the returns on your savings, central banks shape much of your financial reality. In this video, we'll explore how their decisions influence personal finances, investments, and the broader economy. One of the most visible tools of central banks is interest rate control. When inflation rises too quickly, central banks raise rates to slow spending and borrowing, aiming to stabilize prices. Conversely, when the economy struggles, they lower rates to encourage borrowing and investment. These changes directly impact individuals. For example, higher rates mean more expensive mortgages, student loans, and car loans, making it harder for people to manage debt. On the other hand, savers benefit as banks offer better returns on deposits. Beyond interest rates, central banks use complex strategies like quantitative easing, QE, or tightening, QT, to influence money supply. QE involves injecting liquidity into the economy by buying assets like government bonds, which helps stimulate growth during downturns. QT does the opposite by reducing liquidity, which can curb inflation but also slow economic activity. These policies affect the value of currencies, stock markets, and even global trade dynamics. While central bank actions may seem distant or technical, their effects are felt in our daily lives. From fluctuating prices at the grocery store to changes in job availability, central bank policies create both challenges and opportunities. In this video, we'll break it all down and explore how you can navigate these forces to secure your financial future. Let's dive into the specifics by looking at who benefits and who faces difficulties during periods of central bank intervention. Winners and losers of recent central bank policies. When central banks act, there are always winners and losers. Understanding these dynamics is crucial for positioning yourself financially. Let's begin with the winners. Savers are among the first to benefit when interest rates rise. Higher rates lead to increased returns on savings accounts, certificates of deposit, CDs, and other fixed income instruments. For retirees or individuals with significant savings, this environment can provide a steady and predictable income stream. At the same time, certain industries thrive in a high interest rate environment. Banks and financial institutions, for example, often see improved margins, as they can charge more for loans than they pay on deposits. This makes the financial sector an attractive investment during periods of rising rates. Additionally, defensive industries like utilities and consumer staples, which provide essential goods and services, tend to perform well as investors seek stability in uncertain times. However, rising interest rates also create significant challenges for borrowers. Home buyers, for instance, face higher monthly mortgage payments as rates climb, which can make homeownership unaffordable for many. Similarly, businesses that rely on debt to finance growth must contend with higher borrowing costs, which can lead to cutbacks in hiring, expansion, or research and development. The housing market is particularly sensitive to interest rate changes. Higher rates often cool down hot markets, reducing demand and stabilizing prices. While this can be a relief for some buyers, others find themselves priced out due to higher financing costs. In contrast, low interest rate environments typically fuel housing booms, benefiting sellers but creating competition for buyers. Stock markets also react strongly to central bank decisions. In a low-rate environment, growth-oriented sectors like technology thrive, as cheap capital fuels innovation and expansion. Conversely, rising rates often shift investor attention to value stocks and dividend-paying companies, which offer more consistent returns. These shifts highlight the complex interplay between central bank policies and market performance. Key indicators to watch. To understand the broader implications of central bank actions, it's essential to monitor key economic indicators. Inflation, for example, is a primary concern for central banks. When inflation rises too quickly, it erodes purchasing power and destabilizes the economy. Central banks aim to keep inflation within a target range, often around 2%. and use rate adjustments to achieve this. High inflation typically signals forthcoming rate hikes, while low inflation may lead to cuts. Unemployment is another critical metric. Central banks strive to balance inflation control with job market stability. If unemployment rises sharply, they may adopt expansionary policies like lowering interest rates or increasing liquidity to stimulate growth and encourage hiring. Conversely, when the job market is strong, they may tighten policies to prevent the economy from overheating. Currency strength is closely tied to central bank actions. Higher interest rates often attract foreign investment, boosting the value of a country's currency. While a strong currency makes imports cheaper, it can hurt exporters by making their goods more expensive abroad. Monitoring currency trends can provide valuable insights into the broader economic outlook. Bond yields are another key indicator. Rising yields often reflect investor expectations of higher future rates, while falling yields suggest a more accommodative policy environment. These shifts influence mortgage rates, corporate borrowing costs, and even government budgets, making them a vital area to watch. Finally, consumer and business confidence indexes offer a snapshot of economic sentiment. High confidence levels typically lead to increased spending and investment, while declining confidence may prompt central banks to intervene with supportive measures. By keeping an eye on these indicators, you can better anticipate how central bank policies will affect your finances. How to adapt your finances and investments. Central bank policies can create both risks and opportunities for individuals and investors. Adapting your financial strategy to these changes is essential for navigating the shifting landscape. Start by examining your debt. If you have variable rate loans, such as adjustable rate mortgages or lines of credit, consider refinancing or paying them down before rates climb further. Fixed rate loans provide stability, shielding you from future rate hikes. On the investment front, diversification is key. In a rising rate environment, consider increasing exposure to bonds, dividend-paying stocks, and defensive sectors like healthcare or utilities. These assets tend to perform well when markets are volatile. Conversely, during periods of low rates, growth-oriented investments like technology and real estate often offer higher returns. Building a strong emergency fund is another important step. Higher borrowing costs and rising prices can strain household budgets, making it essential to have savings readily available for unexpected expenses. Aim for 3 to 6 months' worth of living expenses in a liquid and secure account. For long-term investors, it's important to stay focused on your goals and avoid overreacting to short-term market fluctuations. While central bank decisions can create temporary volatility, they are only one factor among many that influence the market. Maintaining a disciplined approach and regularly reviewing your portfolio can help you stay on track. Finally, consider seeking professional advice. Financial advisors can provide tailored guidance based on your unique situation and help you navigate the complexities of central bank policies. By staying proactive and informed, you can position yourself to thrive in any economic environment. Looking ahead, opportunities and risks. As we look to the future, central bank decisions will continue to shape the global economy. The Federal Reserve, European Central Bank, and other major institutions are closely watching inflation and employment data to determine their next moves. While some predict a pause in rate hikes, others warn that persistent inflation could necessitate further tightening, prolonging uncertainty for businesses and consumers. Geopolitical developments will also play a critical role. Trade conflicts, energy crises, and other global events could force central banks to adapt their strategies quickly. For individuals and investors, staying informed about these external factors is crucial for anticipating potential impacts. Corporate earnings and economic data will provide additional clues about the trajectory of the economy. Strong results from key industries could signal resilience, while disappointing data may heighten concerns about a slowdown. Monitoring these trends will help you make more informed financial decisions. In conclusion, central bank decisions are among the most influential forces in today's economy. By understanding how their policies impact your personal finances and investments, you can take proactive steps to secure your financial future. Thank you for watching this video. Don't forget to like, subscribe, and share. Until next time, stay financially savvy.